Here we go. Here we go. Hey, y'all doing today, man? It's Friday. You know what time it is. We are back. Stock Market Live weekly update with Financial Blueprint, Antoine Smalls, right? So I love you guys. I appreciate y'all. Continue to rock with me. Continue to subscribe to the channel. Hit the like button. And let's continue to talk about all things stocks. And let's continue to make this money, right? So as you been continuing to rock with the channel, you know that last week we talked about earnings this week, tech earnings this week, big week this week, man. We've had the biggest companies in the world outside of Nvidia, provide their quarter earnings, and it's been an amazing week in the stock market. It's been an amazing week in the stock market, right? So if you've been investing, if you're somebody that is someone that has been taking the game, taking the information that we've been putting out on this channel. You've been investing your money. You've been buying the stocks at the prices that we talked about, right? The best companies in the world. You definitely made some money this week, and I'm so happy for you, right? I'm happy about the gains. I'm happy about the execution of information, and ultimately the putting the money to work for you and your family, right? So outside of tech earnings this week, we also had the Fed, right? Federal interest rates, Fed meeting this week. Federal interest rates came down another 25 basis points. And we're going to start off with the Fed because we know we're in an easing cycle and the markets react well to lower interest rates. The other side of that, though, is the markets also react to the forecast for interest rates going forward into December and into the next year. So we're going to start off with the Federal Reserve Chair, Jerome Powell, talking about all things interest rates, and then we're going to move into tech earnings. And we got so much to go through: Apple, Meta, Netflix, Google, Microsoft, and then last but not least, the charts. Right. So let's take a look at the Federal Chair, Jerome Powell, and what he had to say this week about federal interest rates and the forecast moving forward.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggest that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem.
As we discussed in the past, we know that the Fed has two mandates, right? Lower unemployment and lower inflation. Right now, due to our government shutdown, we have a period to where we are missing data and good information to be able to justify rate cuts in the near future, right? So the Fed chair and the committee agreed to cut 25 basis points this month, right? Just about 2 days ago on Wednesday. However, if we continue on to this conversation later on when he starts answering questions, the Federal Reserve Chair Jerome Powell basically states that because inflation is reading higher than what they would like it to be right now, right? They have a 2% inflation goal, right? Right now we are still above or around that 3% mark, so that is too high, right? When it comes to the rate of inflation in the United States, and that's taken in consideration everything, goods, services, etc. Right. So due to the 3%, kind of like it's like a plateau line where they trying to get it consistently under that 3% towards that 2% goal mandate, right? That is causing some issues, and we have tariffs, we have other things going on around the world that is affecting the rate of inflation. Right. And then without the reports from the government due to the government shutdown, we have not been able to get clear understanding of where we are when it comes to inflation as well as unemployment, because the last time we had a read of unemployment, it was 4.3%. And the forecast for the end of the year is 4.5%. So the Fed's in a rock and a hard place right now. Right. So the markets, although on a positive side, took in consideration that they did lower interest rates, which was a 99% chance of them doing so today. The market also did not like the fact that there was a little uncertainty when it came to Jerome Powell's answering a question when he talked about December rate cut. Right? It doesn't mean that December rate cut is not going to happen. It means that the federal chair is needs more information. Hopefully the government shutdown will end so that we can get reports of inflation reports as well as unemployment reports, jobs reports, to where they can make a good decision or in a month on if they're going to continue to lower interest rates. Just always understand that the stock market always is a forward leaning system, right? So the stock market is always adjusting based on the forecast in the next, 3 to 6 months, right? So when you have a event that's happening and the forecast is murky, or you have a forecast for a company that's uncertain, the stock usually doesn't do that well based on the not just the earnings that we're going to go through now, but the forecast for what's about to happen over the next few months, right? So we got the interest rate cut, which is good, right? Now we're going to be in this little murky phase. We're going to talk about the market, and we're going to get to, what the current charts look like and all that good stuff later on. But right now we have some uncertainty going on based on the fact that the Fed does not know if they're going to cut rates in December, based on the fact that the government is shut down and they cannot receive the reports they need to be successful at their job, right? So right now we're in this in between phase. But understand this: the best time to invest in the stock market historically is the month of November. The month of November provides the best gains every year. Historically, the month of November does really well when it comes to the stock market. So going into the earnings picture, we talked about this before. We need the rate cut. If we want stocks to continue to move forward, we need the rate cut. We got the rate cut. We also need earnings when it comes to technology companies to be really good. This week, we got some good earnings. But before we get into the earnings, let's take a look at the overall picture of earnings and the stocks that we will be talking about and discussing right now on this video.
I was just looking at the things that are the names that are having the biggest negative impact on the S&P. It's not surprisingly Meta and Microsoft, but it's NVIDIA, it's AMD, it's Oracle. It's all those names that have been powering the market higher so far this year. Is this a meaningful inflection point, or is this just a reaction to some earnings and people deciding, I guess, to put their bets in different places?
No, I do not believe that this is an inflection point. I think this is just a return to a degree of normalcy off of what has been a really strong outperformance from the segment of the market that you just identified, Mag 7, AI adjacent. Keep in mind the significant underperformance of the S&P equal weight over the last several days. We were citing statistics that the differential in performance between the S&P and the S&P equal weight was the largest that we had seen since the 1990s. So if you run an equally weighted strategy, I'll raise my hand. Okay, when you run that equally weighted strategy, a day like today offers a degree of relief. S&P equal weight is up about 40 basis points. So you're kind of getting a little bit of a return to normalcy more than anything else. We'll dig into the numbers as it relates to the three mega caps that reported. There was some good there, there was some bad there, but I think the commonality of all of it was about, okay, what's your cloud revenue? Because that's how we're going to see if you're monetizing the AI spending, and what are you thinking about looking forward in terms of your AI spending, and where's that capital going to be coming from?
All right, speaking of commonality, Microsoft and Meta, they have one thing in common, taking that charge. Investors don't seem to like surprises. Other than that, they seem like pretty good reports, Steph. Other than raising the CapEx, was there something else in those two reports that you didn't like that you think justifies these downside moves?
No, I thought these quarters both of them were very good. Expenses, that's the sensitive point for all of these stocks. How much are these companies spending? We know they were going to spend $400 billion in CapEx, the big ones, the big names this year. Now it seems to be even a little bit more. So for me, I looked at Microsoft, and I was not an owner yesterday. I am now an owner today, because I'm looking at this report, and they beat in all three segments. They beat revenues by 3%. They had commercial bookings up 111% year over year. Their RPOs grew 51%. That's future look at revenues to come. Azure, I know everyone wanted 40% Azure growth. They got 39%. I think that is silly because it expanded 200 basis points, but that was the sticking point. They wanted a clear beat. I think that still is very, very positive. And so to me, down 3.5%, 4% when it opened this morning, I started adding to a position.
You know, in all fairness, that 40% was kind of the whisper number. They did actually beat the estimates according to Street account, but the 40% was kind of that number out there in the street lurking. I want to go back to that RPO. I was actually talking to the team about that.
Yeah.
Up 51% year over year, about $300 billion, and it doesn't account for OpenAI.
That's right.
So it could be even bigger. We made such a big deal about Oracle and their RPO. Why do you think investors are just shrugging off Microsoft's RPO?
They're just, look, the stock was up 28% headed into the print, and they were expecting a big beat, a bigger beat in Azure. Really, that was really the story. The last couple of quarters, the company has been able to beat their Azure numbers by 300 and 400 basis points. So this only 200 basis point beat is the reason why I think you're just seeing us sell the news. There's nothing in here that is alarming whatsoever. And if you want to go into Meta, we can go into Meta, because that quarter.
I mean, you led us there, Steph. You might
I'll
as well
go there.
Go ahead.
I'm going to go there.
Now, before we get into Meta, right, this is important. And actually, let me just go back to Microsoft's chart really quickly. Now, understand, I am going to talk to the new investor, right? And most of my content really goes to people that are new to the stock market, that are new to the financial literacy game, and really want to get started and want to learn, right? If you're an intermediate or an advanced investor and you know macro dynamics and macroeconomics, and you understand what bottom momentum and sell the news and all of those different dynamics of earnings and things like that, understand. God bless you. Hope you stay invested long term. Make your money, right? For the new investor that doesn't understand why a stock like Microsoft, and we're gonna get into Meta in a second, because Meta took a crazy dip this week, which was an amazing buying opportunity. But before we get into Meta, let's go into Microsoft. Microsoft beat across the board. However, their stock dropped. And again, it didn't drop a lot. 3% to me is not a lot, but it did drop. And actually, if you go into Microsoft right now is at $516 a share. So right now it is currently dropping again a little bit more, another 1.5%, almost 1.75%, almost at 2% drop, right? Dip. And as Stephanie Link said on this video, she wasn't a owner of Microsoft prior to this earnings report, but now she bought into the company at a discount. This is so important to understand, right? I don't play earnings from the standpoint that I want to try to make a whole lot of money on one report and up or down, etc., right? I'm looking at earnings and seeing how great the company is, what their profit margin, operational margin, what is their estimated, like what was their numbers for the quarter, what is their estimates moving forward? Does the company continue to make money? Is the company continuing to, raise their margins when it comes to their, profit margins, operating margins, things like that? Is the cloud business for Microsoft continuing to grow? Like you gotta look into the details, right? Because then that can then tell you, okay, this company is still growing at a good pace. They have a great balance sheet, profit margins off the chain. Okay, cool. So a 3% dip, and actually, if we look at this right now, it's almost at a 5% dip in 2 days. What does that tell me as an investor? I should be buying into the stock. Now, what price do you buy it is a great question. Honestly, I'm looking at 516.46 right now on this stock. I bought more shares today, and I'm considering buying in a leap option going out to 2027. But I'm really looking at the possibility that Microsoft may come down to about that $500 range next week. And if that were to happen, I'm pulling the trigger, executing at a high level, and I'm buying a option out to January of 2027. So it's always about being opportunistic. And when you see these great companies and they report great earnings when they were running up into the earnings report, and then they take that small, dip down about 5 to 10%, that is absolutely a buying opportunity. You do not miss on those opportunities when they come, right? And she's about to get into Meta, and we're gonna have the Meta conversation because listen, Meta is another one. I'm not currently invested in it. I was earlier this year. It ran up. I sold, but honestly, I am considering jumping back into Meta and making that a long-term hold at the current prices. But let's take a look at Meta and let's move forward. But again, I wanna harp on the fact that if you are a new investor and you always have to look at things from an opportunistic perspective, especially when there are great companies at discounts. You know, buy when companies go down. If they're great companies and you are confident in their long-term future aspects of things. And again, it's all about the long term. We're not making trades for 3 months. We're looking out years. And my leap options, my options go out at least a year, almost a year and a half, almost 2 years in some cases. So, take a look at some of these great companies that reported this week. If you see these dips, hey, great opportunity to get some shares.
That quarter.
I mean, you led us there, Steph.
I'll go there.
Go ahead.
I'm going to go there because I added to
there.
that this morning, too, because I think down 12% is absolutely silly. Look, I mean, I was not happy that expenses went higher. None of us are happy that expenses went higher, but the higher expenses are leading to very strong growth. You're going to see 21% growth this year in total revenues, operating margins at 40%. If you look at what they actually reported in the quarter, they beat revenues by 400 basis points and grew 26%. Operating margins also beat at 40.1%. The family of apps, that actually beat as well. So you see the revenue is coming in better than expected. And so the spend is working. And also, by the way, they're seeing ad impressions up 14% and price per ad up 10%. They're seeing monetization. That is exactly what I wanted to see. So not happy at all about expenses, but down 12% after you see this kind of growth. So you're now at 21 times forward estimates for 21% plus growth.
Steph, you came ready to talk about Meta. You had all the metrics right at the tip of the tongue there. Jim, I don't want to leave you out of this one. You own Alphabet. I mean, everything was pretty good. Everything was pretty good. One of the things that really stuck out to me was the Gemini numbers, the monthly numbers. I mean, trailing OpenAI by a lot. It was $650 million a month compared to like $800 million a week. So there's a big gap there. But is that encouraging when you're seeing that growth from Gemini at the same time the search numbers beat expectations?
Yeah, the search numbers beating expectations is very encouraging. So is the fact that the cloud services, Frank, were up 34%.
So we got a quick spiel on all of these companies. We're going to talk about them more in detail one by one. But he just switched over from Meta, and we're going to talk Meta more next. And now they're talking about Alphabet, and I love Alphabet.
And YouTube's doing well, et cetera, et cetera. I mean, basically, this is a multi-cylinder engine that is firing on all cylinders. I think what is intriguing, though, is where you started, because if you go back 5 months ago, we had a big controversy in the markets about what exactly was going on with the search business at Alphabet, at Google. And you'll remember Eddy Cue, Senior Vice President at Apple, was testifying that on Safari, they were seeing Google search queries going down. That evening, just to remind everybody, that evening, Google came out with a press release saying, hey, we're seeing search queries going up, including on Safari. Now, that I have been unable to square those two facts, those two statements since then. And what we've had in addition since then are two earnings reports from Alphabet that clearly shows the search business is growing really quite well, and they've figured out how to use artificial intelligence. Whether it's the AI overview, Gemini, they have many different ways that they are figuring out how to monetize and use AI. So I think in this controversy, this conflict that I can't resolve, it's now clear that Google, Alphabet was right, and the search revenue is going terrifically. Let me go also to the cloud business, as I said, up 34%, increasing margins. You've got a huge backlog. I think the backlog was up 45%. A lot of that coming from companies like Anthropic. So there's just a lot of things going right at Alphabet. Steph, to what you said about Meta and the valuation, totally agree. I'm not in that stock, but the valuation, where it is on Alphabet is similar. meaning that there are probably future gains ahead. I will say this regard to the overall market, whether it's Meta down, Microsoft. Look, the markets don't go up every day. You know, the last several days we've kind of gotten accustomed to NVIDIA. I know we haven't talked about it, but NVIDIA adding $200 billion of market cap a day. Guys, that's not going to continue every day. Let's take a breath here.
If I could.
So let's be real here. I think it's time that Google gets its due. Google is a great company, but for a long time, we have kind of taken Google for granted. They've had some issues when it came to their Google search. There was some, issues. They had to go to court and they had to, possibly break up their business. So a lot of people didn't invest in Google based on the possibility that their business would be broken up. We know that that's no longer the case anymore. They're flying high. I mean, their cloud business is doing well. You got YouTube. Apparently, YouTube is almost as big as Netflix. If they spun off YouTube into its own company, YouTube stock would be crazy alone, right? So if you consider the fact that you have Google Cloud, you got Google Search, they got AI and Gemini, they have the Google business where Google Ads, where people pay for the ads, right? And they're making all of this money, as well as they have a quantum chip that they just spun out. They might be the one of the first quantum computing players, and we haven't even started having that conversation about the quantum space. So I bought into Google last year when it was, earlier this year when it was down. I believe it was about $160 a share, and I was like, "Look, listen, this is too good of a company to be down this low." And it was a great time to buy into the great stock at the time to buy into the price. And again, this is those opportunities that I'll be talking about. Google is now the second highest weighted company in my portfolio. And I honestly think I need to buy more shares because their stock is so great. They've ran up. Their earnings was amazing. And they are going to easily be over this $300 a share threshold very quickly, right? So let's get into one of the best companies in the world, their earnings. We all know them to be Apple, right? iPhone sales was great for the iPhone 17. Their earnings was great, and the market definitely pushed up due to the earnings for Apple.
What do the Apple numbers look like?
Yeah, John, we got beats on the top and bottom lines here. Let me go through. There's a lot to unpack here as we see the stock down about 3% on first blush. EPS was a beat, $1.85 compared to $1.77 expected. Revenue, a small beat here, $102.47 billion. Street wanted to see 102.24. Now, iPhone revenues, it was a miss. That might be why we're seeing some negative reaction here, but sales were still up 6% year on year. They came in at 49.03 billion. Street was looking for a little over 50 billion. Now, services, this is, of course, the big growth engine for Apple. It was up 15% year on year to 28.75 billion. That's a slight beat here. Street wanted to see 28.17 billion. And by the way, this is the end of the fiscal year. This is the first time the services business booked over $100 billion in a year. China sales, they were down about 3.5%. However, we did get some guidance this time ahead of the earnings call. I was just back there in Apple Park talking to Tim Cook about this. He was literally beaming about this guidance. December quarter revenue, they are saying it's going to be up 10 to 12% year on year. And iPhone revenue for the December quarter, they're now predicting up double digits year on year and saying this is going to be the best ever sales for the iPhone in the December quarter. So really strong guidance here, despite maybe little pockets of weakness in the September quarter results. And then as far as some other data here. I did talk to Tim Cook about those results and talking about the demand for the iPhone 17. I know Dan Ives was just talking about this. He even said there was demand for the iPhone 16 at the tail end of that life cycle. Here's what he said. On the 16 and 17 for Q4, several models were supply constrained, and currently we're supply constrained on several models of the iPhone 17. That is, again, why we're seeing such strength there in the guidance numbers that they gave us. As far as China, Tim Cook telling me, quote, we expect China to return to growth this quarter because of the reception of the iPhone there, or the iPhone 17 family. And then, of course, we had to catch up on artificial intelligence. Tim Cook telling us that big AI update to Siri is still on track to launch next year. And also, we talked a little bit about integrating some other AI models in there. There have been so many talks about whether that's Google or what have you. He told us, quote, in terms of the integration, we've integrated with ChatGPT, and our intention is to integrate with more people over time. No specific partnership to announce today, but you can think of it as more coming. So a lot to unpack there. Really strong guidance despite some disappointment there, at least from the street's perspective in the iPhone. But still, iPhone sales up 6% and trending towards the best December quarter ever for iPhone, John.
So Apple, has been under fire recently due to the fact that their artificial intelligence forecast when it comes to their phones and the software that's on these phones has not worked out nearly as well as expected, right? So the year of 2025, this year, the stock kind of struggled for a while. And this was the first quarter to where the results show that their iPhone sales is rising, right? In December, and because you got to remember, this is a Q3 report. So the iPhone came out in September. So they can only forecast, or they can only show you what the sales were up through September. But the fourth quarter, October, November, and December, they will then show what their actual iPhone 17 sales. And it's looking like iPhone 17 is definitely has a strong demand, and a lot of people are upgrading their iPhones. Me personally, I am waiting for the iPhone 18. I will be getting an 18 Pro. Definitely looking forward to next year, next fall for the iPhone. So the Apple stock has done pretty well since their earnings, and they are currently where we at? Apple is currently at $270 a share. It did reach an all-time high today at $277. So Apple stock has definitely ran up from its April low, which was 168. So if you are someone that invested in Apple down in there at that 168 level and you ran all the way up to that 277, definitely making a lot of money. Apple is one of those companies that you can hold long term. It is definitely a player when it comes to the best companies in the world. NVIDIA has taken over that mantle as the best, but Apple for a long time was the best, and it's still obviously top 5 when it comes to the best companies in the world. So Apple is looking pretty good as they continue to forecast artificial intelligence as well as partnerships with ChatGPT, OpenAI, as well as other players, possibly Perplexity and things like that. I think that Apple will do well and will continue to be a great company moving forward, right? So we talked a little bit about Meta, right? And how Meta earnings came in positive, but they had a very, very extremely negative reaction to the stock, and the stock dropped above 10% in a day, which is a lot for a stock to move on earnings. And so let's go into Meta's earnings and let's see why the stock dropped.
That Meta results are out. Stock is headed lower, and we can go to Julia Boorstin on that right now. Julia, I wonder if you can see why the stock is down 7% or so.
Well, earnings and revenue both beat expectations. Adjusted earnings of $7.25. That's ahead of estimates of $6.69, but that includes a one-time non-cash income tax charge of $15.9 billion. But that without that one-time charge, which is due to the big beautiful bill, President Trump's big beautiful deal bill, that would have been an EPS beat. Revenues also ahead of estimates. Daily active people ahead of estimates, 3.54 billion versus 3.49 billion estimated. And the average price per ad was up 10% in the quarter versus an 11% gain that the street account estimate had anticipated. Now, in terms of Q4 revenues, the company is guiding to Q4 revenues between 56 billion and 59 billion. That compares to the 57.25 billion estimated. And they say the outlook reflects an expectation for continued strong ad revenue growth, partially offset by lower year-over-year Reality Labs revenue in the fourth quarter. We're going to continue to dig into this. Does seem like everyone is working through this one-time non-cash income tax charge and its impact on the company, as well as some other factors. Back over to you.
All right, Julia, thanks. That stock still down more than 6.5%. Microsoft's off the lows, but still down nearly 3%.
So we seen Meta stock go down significantly. Significantly is a word. A Meta stock went down a lot in 2 days, right? Meta is currently sitting at $654.24 as of right now. $654, right? It was just sitting around 700. It was at almost 750. So we're talking about $100 like drop in the stock price. So again, great company due to that tax bill, as well as the CapEx spend that the and the profit margin drop due to the CapEx spend for Meta and Zuckerberg. A lot of investors did not like that, so they end up, the stock dipped significantly, and it is currently going down again. And again, this is a great company. This is a definitely a business and an A company. Most users, when it comes to Facebook and Instagram, the businesses with WhatsApp and LinkedIn, it is an amazing company. And if you are a new investor or someone like me that's looking into possibly investing in some money into a new stock to add to the portfolio, this is an opportunity. This is definitely an opportunity. And sitting at 653, again, I am looking at a price level that I would like to get into, which is closer to $600. If this stock continues to drop over the next few days, next week, early next week, I could easily see myself buying a few shares, as well as possibly getting into a LEAP contract out to 2027. So Meta had earnings. They had a beat across the board due to a tax bill, as well as the CapEx spend that went skyrocketed due to Zuckerberg trying to build out AI infrastructure within the company. A lot of investors did not necessarily like that. So that stock dropped this week, and it is currently still moving down as of this today, right now on Friday. It's currently still moving down, right? So we talked about, let's move on. We talked about Netflix multiple times over the last couple of weeks. We talked about it multiple times. I love when I talk about certain things and I say, hey, this is an opportunity to buy into the stock. This is an opportunity to get into this company. And we're going to get into Amazon later, because Amazon did the opposite of Meta. It went up like crazy, and a lot of people are making a ton of money, right? So Netflix is a company that we talked about. It dropped down, I believe, to that 1090 level, 1070 level. And I was like, yo, this is a great time to possibly buy into the stock. Netflix just announced a 10-to-1 stock split. I'll repeat this again. Netflix has announced a 10-to-1 stock split that goes into effect, I believe, November the 17th. is when Netflix is going to split its stock 10-1. And if you don't know what a stock split is, basically, Netflix just announced a 10-1 stock split effective after market close on Friday, November the 14th, not the 17th. Friday, November the 14th. Basically, for every one share that you own, you're going to receive 9 additional shares. And I'll repeat this again, for each one share that you own, you will receive an additional 9 shares as they split the stock 10-1, right? To lower the share price. Right? You look at a pie, you splitting the pie into 10 pieces. For every one share that you own, you get 9 additional shares. What happens is like, let's say that Netflix's stock is $1,000, which is not, but let's say it's $1,000. You divide that by 10, that's 100. So basically, instead of you having 1 shares at 1,000, you now have 10 shares at 100. Why is this important? Because then it allows a lot more retail investors, regular people, to afford a stock price versus Netflix that's currently sitting at about $1,100 a share. So it's much easier for the regular individual, the regular person, to buy Netflix at $100 a share versus $1,100 a share, right? So let's go into Netflix and them splitting their stock. And let's talk about that for a second.
News on Netflix. Netflix just announcing a 10-for-1 stock split that will be effected through an amendment to the company's certificate of incorporation. And that is set to be as of the close of trading on Monday, November 10th. We see Netflix shares up about 2.5% on this news.
All right. So if you are interested in buying Netflix, definitely get into a couple of shares. It will give you 9 additional shares for every 1 share that you own. It is a company that is a long-term investment for sure, and it is a great company. Now, understand this: stocks run on momentum, right? So you will see a run up to the stock split when it comes to Netflix. You'll see the stock price continue to run up. So if you're looking to get into it now, it's not a bad idea. However, usually there is a sell the news event, which happens after a stock split, in which the stock price does come down a little bit. So do not feel as though if you're someone that don't have $1,100 to spend on Netflix today, that you're not going to have an opportunity to get into it after the stock split. You will have an opportunity to buy into the stock after the stock split. You never want to buy any stock at a high. But it is very important you understand that buying it now, you might see some gains up until the stock split happens, which is in about 2 weeks. If you want to wait until after, that's all good. That's fine. But Netflix is definitely splitting its stock, and it is an opportunity to buy into the stock. And just to be honest with you, I have Netflix. My daughter has it in her investment account. So Netflix is definitely a company that I support, and I'm very much looking forward to the stock split and to get more additional shares long term for the investment portfolios, right? So next earnings we have is Microsoft, one of my favorite companies. We talked about it a little bit in the previous video. Now we're going to get more in depth about Microsoft. So let's go into Microsoft earnings report. And let's see how the company reported this past a couple of days ago on Wednesday.
Dropping here despite some beats on the top and bottom line and on Azure cloud growth. EPS was a beat at $4.13. Street wanted to see $3.67. Revenue here a beat as well, $77.67 billion. Street was looking for $75.33 billion. And Azure cloud growth, again, another beat here, 40% growth year over year compared to expectations of 38.2%. We're seeing shares drop here about 4.5%. I'm going to keep digging through and find out what's going on, and I'll be right back with some more color for you guys. Yeah, that's right, Morgan. One possible explanation, I'm digging through the numbers here to explain why we're seeing the shares go down. Intelligent Cloud was a slight miss. We're looking at $30.9 billion compared to $30.25 billion. It's a very tiny miss, but that said, it's the only miss I'm seeing in the metrics that we follow closely here. We're going to get some more data here on the earnings call. That's when we're going to get those CapEx numbers, guidance, and so many other things that could move the stock the other way. But right now, a miss on Intelligent Cloud is the only thing I'm seeing that could be a drag on the stock here after hours, guys.
All right. So Microsoft beat across the board. They did miss in that one, gentleman stated, but the revenue was a beat. The earnings was a beat. And the cloud revenue continues to move forward as Microsoft. And really, Microsoft is one of them companies that, like, you got to understand, they got their arms into OpenAI when it comes to their 27% stake into ChatGPT and OpenAI. As they continue to progress and go public in the future. Microsoft obviously is a stalwart company within the United States in so many ways. The cloud, the devices, the technology, artificial intelligence it's now possibly, they could get into cybersecurity, they could get into defense in that same way when it comes to cybersecurity, possibly in the future. Microsoft Office, Microsoft Azure. They're just an amazing company, which is one of the reasons why Microsoft is the number 2 weighted company in my portfolio, right? So anytime I see opportunities and stocks drop on good news, selling news events, I'm always looking to buy more shares. Currently, Microsoft is currently at $516 a share. Again, man, if I'm looking to that Monday, Tuesday time frame to see if we can continue to see a downward movement in some of these stocks, and if we can get Microsoft around that $500 level, I am buying, and I'm buying. Not just shares, but I'm looking at a 575 leap, or possibly even 600 going out a year to about a year and a half, right? So we are definitely looking forward to more Microsoft news, and possibly if we see some more red into the Microsoft space, we will definitely look to buy more shares and possibly a leap, going out for about a year or so. Okay. We talked about Google, and we're going to get more in detail about Google right now. Alphabet is an AI winner. It's something that we all need to pay attention to as investors. It is one of the cheapest AI plays out there right now. And even with the stock price going up, even with the growth that has been shown, it is still an underappreciated name. And I think that we need to take more time and look into Alphabet and Google ultimately as a whole. And I mean, look, YouTube is an amazing business alone, and that doesn't even include some of the other things that Alphabet got going on when it comes to Chrome, when it comes to the Google Ads business, the cloud business, and that moving forward. And we haven't even taken a look at the quantum space yet. Google is definitely a great player. Let's take a look at it.
Now with more, Michael Nathanson, founding partner, senior research analyst at MoffettNathanson. Michael, thank you very much for joining us. You have argued, I believe, on this very program and in your research that Alphabet should be the most valuable company in the world. Why?
Thanks for having me. It's an AI winner, right? I think what people are starting to wake up to is that their infrastructure advantage lets them invest in AI more efficiently than almost any other company, right, Brian? So you're seeing the results of their investment in cloud, in search, Waymo. And our view is, look, this keeps going. And because they own the infrastructure TPUs, they don't have to pay NVIDIA the same, up margin upside, that NVIDIA is demanding to invest in AI, right? So our view is, search, and this has been a big, kind of debate. Search actually gets better with AI, as do the other parts of business of Google. So our view is like,
all I hear about, Michael, is that AI is going to kill search. And OpenAI now has its own browser. Anthropic has its own app. Why are you so confident that those things will not severely damage Alphabet's core business?
because Alphabet's core business is selling advertising as part of search, right? And if you look at the challenges of other people trying to build really valuable, competitive, performance-based marketing, it's just really, really hard. So Alphabet has, that these others don't, they have a great view of who you are, either from Google Maps, YouTube, Gmail, search, right? They know it's you, Brian, not me. They have the best ability to drive, performance advertising to a better return on sales than anyone else. So our feeling is, you're watching the traffic change, but as more people deliver, ask queries that give you more and more targeted answers, the value of that answer goes up in the eyes of advertisers, right?
But don't they have to do that question, that search, that query from an Alphabet, from a Google product?
Yes, but look at the growth they've had. Fair enough, they stumbled in the beginning with Bard and their earliest, competitive actions versus ChatGPT. Look at the growth of Gemini now, 650 million people. They added 200 million people in a quarter, right? They have all the surfaces that we use. Their job is to get us to use, either AI mode in search or Gemini, and that's starting to work, right? So no doubt that ChatGPT will eat into their share of queries, but our view is that they can monetize those queries better than anyone else.
Yeah, we like the bullish view on Alphabet because we've just heard so much on the other side how Google's dead and OpenAI is going to kill it. Guess what? Record high today. That stock up 3%. All Alphabet keeps doing is winning. Mike,
that's a fact. Yo, that is a fact. All Alphabet continues to do is win. And I want to take you back to this chart right here, this little screenshot, right? If you pay attention, right, Alphabet stock price was $283.13. Currently, it is $281 right now. So from this time of this video, which was yesterday, and to the time it is right now, actually that was earlier today, because Google went up to 286 today and it dropped down a little bit to 281. So currently it's sitting at 281. But I want to pay attention. I want everybody to pay attention to the PE ratio. If you look at this PE ratio here, right, it's 28.34 forward PE ratio. It's a ratio that really takes in consideration price to earnings and basically how expensive the stock is. And if you compare it to S&P 500 as a whole, all of the stocks in the stock market index, Google is very much cheaper than any other AI play currently right now. And this is very important for you to understand when it comes to the stock price, because if you look at the stock market as a seesaw in a sense that you have stocks that go up really high, very fast, their ratios get really high, they get really expensive. So then that they kind of correct down, right? And then you have the stocks that are a little bit more of a slower moving upward. It's kind of like an escalator, but it's a slower escalator up. Stocks like Microsoft, stocks like Apple, right? In this case, Google. And then you obviously have players like AMD skyrocketing. Nvidia at one point was an absolute monster, like just going up at an insane speed, right? Tesla does the same thing, right? Really volatile stocks. These stocks, which are more, I would say, consistent movers up, but they also do not draw down nearly as much when it comes to volatility, are a lot better to play in when it comes to long-term investments, because it's easier to understand, a Google going up, Microsoft going up, and Apple going up, versus the volatility of a Tesla that might go to 400, but also might come down to 200. And now you got to figure out how you want to invest. It's more of a trade than a long-term investment, and just in my standpoint. So Google has an ability to run a lot more than it currently is right now due to its PE ratio, due to the fact that it's still cheap according to the players in its space. As we get more into this artificial intelligence game and we really talk about quantum computing, I'm telling y'all right now, Google is a monster. You might not necessarily want to invest at it at 281. You might want to wait for a pullback. But I've been in this stock since 160. It is second highest, weighted company in my portfolio. I am not looking to sell this at all. I'm looking to gain and add more shares as much as I possibly can. I'm not buying it at these levels right now. But if it ever were to come down to that 260, 250 price level, I'm definitely looking to get more shares into Google, right? And if you invested in Google back in April, it was down to $140 a share in April. Oh my Lord. And you would have made double your money in just a 5 to 6 month timeline, right? So this is why investing in the market is so amazing. If you can get into these companies, great companies at a discounted price, it is definitely a major opportunity for you to grow your money long term. So that is Google, one of my favorite companies in the world. It had great earnings this week. The stock price did continue to move up, and it is currently sitting at 281 a share, right? So another company that also went up significantly was Amazon. And why am I smiling? Because just a few weeks ago, or almost a month ago, if you're following the Financial Blueprint channel by Antoine Smalls, looking at the stock market live videos. We do this every week. We take a look at the market. We give out prices. We talk about stocks. We bring up the charts. We do this every week. YouTube, Facebook, as I always say, hit the like button, subscribe to the YouTube channel, hit the like button, share this content when that someone needs to hear it. Leave me a comment on what you are investing in right now as we continue to push forward every week on our stock market live show on Fridays. Now I'm going to talk my talk for a second. Amazon was at $215 a share. I said, yo, Amazon is not moving. It's not moving up like some of these other stocks. It is not skyrocketing. Like, it's not moving crazy like Google. It's not doing, but I see amazing things coming down the pike with Amazon, and I'm telling y'all, I bought options at 217. I remember this. It was 220. It was then got down to 217. I said I'm buying options at 217. It got down as low as I believe 215, and maybe it got lower close to that 210 or 12 level. Let me look at Amazon real quick. Oh my Lord, it's up to 11% in one day. Where the charts at? Come on. Yep. It got down to 211 on it got down to 211, but this was back. That's August. It came back down to 211. What was that? October the 17th. Yep. A couple weeks ago. 2 weeks ago, it came down to 211. And I told y'all, I said, this is one of the 3 stocks that I'm investing in right now. I'm buying them I'm buying as many shares as I can. I bought 2 contracts. I bought 2 265 strike prices going out to August of 2026. Let's go into Amazon and let's look at what Amazon did on earnings, and let's see where Amazon currently is right now. Let's take a look at it.
Apple and Amazon beating expectations as Apple projected record December revenue and Amazon saw its cloud business accelerate. Joining us right now to talk about all of this is Dan Flax. He is Neuberger Berman Senior Research Analyst. And Dan, both of these stocks higher today, Apple by about 2%, Amazon by close to 13%. Why don't we start with Amazon just because of the outsized gains that you're seeing here today? What caught you the most off guard? What surprised you the most with the numbers there?
Good morning, Becky. What we saw is very good growth at Amazon Web Services, which accelerated to about 20%. And so what we're seeing here is that the company is innovating and executing effectively in very important areas, for example, on their silicon roadmap. And when we speak to customers, they get a tremendous amount of value from Amazon Web Services. It's really about empowering others to build on top. And so I think Amazon's executing well there. The e-commerce business remains healthy, and so we continue to like the name here.
Just look at the chart. Listen. To all my new investors, the people that's just checking me out on the channel, understand this. You know, when I say, hey man, it's a stock that I'm looking at, it's a stock that I'm, looking to invest in long term. I'm not telling you to just buy the stock. I'm saying do your own research. Obviously, make decisions based on your investing strategy. But there's certain times or certain situations that certain things is no brainer. Amazon is one of the best companies in the world. It is definitely one of the top, I would say, 5 to 7 companies that will continue to propel the United States, the GDP of the country, and ultimately the future of not just retail, but also artificial intelligence. AWS is an absolute monster. And the future robotics, when we talk Tesla and we talk about robotics and automation and things like that, Amazon is one of the top players in that space too. When we talk about the fact that it's been reported that Amazon is looking to lay off as many as 500,000 employees, human capital across the board getting taken away. Now, sure, you can go into the negative side of that when it comes to unemployment. That's a fact. That's a fact. We've been talking about the fact that artificial intelligence and robotics is about to take your job. We didn't said it over and over and over again. And if you haven't taken notice, you will take notice now when UPS, Amazon, Microsoft, other companies have reported that they're going to be laying off hundreds of thousands of people over the next year. But understand that as an investor, when you lay off human capital, you take money off of the balance sheet, you take money off of the payroll, which then increases profits, which increases the operating margin of the company, which then ultimately means that the investors make more money. This is why I say you got to get out of the space of being a consumer but go into the ownership assets level where you are then accumulating assets to ultimately make you money. Because sure, Amazon, a company, might be bad necessarily for employment because they're going to take, jobs away and give it to a robot that can then work 24 hours a day without having to pay for medical insurance, without having to pay you a salary, without having to do X, Y, and Z. This robot is going to continue to just work and work and work and ultimately build the business long term, which then helps the investors in a company make more money. So as an investor in Amazon, I love this, which is obviously the reason why the stock price went up like crazy. And look at this jump on earnings. 12%. A company of this size going up 12% on earnings is insane. But when you wake up in the morning and you look at the pre-market and you say, oh my Lord, have mercy, this stock is up 13% after hours, and you got options going out to 26, and you at a strike price of 265, and you looking at this share price and it's at 250, oh, we up crazy bags. We up crazy bags. And you know what's crazy though? It ain't gonna slow down. Amazon is looking to be over $300 a share. I would say that Amazon should be over $300 a share by 2027. By the end of next year, we could possibly see Amazon reach above $300 a share. Very similar to where Google is right now when it comes to the share price. Google's higher, obviously, but Amazon is taking a step forward, and if they can continue to execute and they continue to lay off people, as this is the bad part, but it's also capitalism from the highest level. You lay off people, you pay less salary, you pay less on the payroll side. You don't have to worry about all of the medical insurances and all of the money that comes out when it comes to that. When it comes to warehouse workers and corporate workers, and you're utilizing artificial intelligence, AWS is continue to expand, and the company continues to make money, but also then not have to spend as much. We know that is profits. So the margin for Amazon, a profit margin for Amazon, been in the single digits. They were nonprofit. They were a nonprofit company, not nonprofit. They were not a profitable company for a long time. Jeff Bezos built this company to be a growth company, not necessarily a great profit company, but they are now trying to maneuver the company into more profitability, which then ultimately will leave more money for the investors, which then will raise the share price over the long term. So this is another great company for my daughter's investment account. This is another great company for a retirement account. Amazing gains, not just in one day, but also moving forward. As you can see, Amazon down in April timeframe. If you're looking at that chart, let's look at what Amazon's share price was in April. $161 a share. It got down to 161. As the time of this video right now, Amazon is currently at $146 a share. It moves up and down, but it's up over 10% in a day. I called this. I said invest into it. I hope you did. If you did, babe, leave me a comment. Tell me you invested. How many shares you got? One of my buddies, he called me. He said, what company should I be investing in? I said, listen, Amazon at $215. You should buy it right now. And I texted him yesterday, and he said he bought a few shares, and I'm happy for him because he made some money.
What's your price target, if you have one, over the next 12 months?
I can't give you a specific price target, but what I would say is that this is a company that's investing hundreds of billions of dollars across a number of different businesses. So their e-commerce business, of course, Amazon Web Services. They have an advertising business over $60 billion with over 20% growth. And so when we look out both in the near and the longer term, we see very, very strong performance here. And I think that's going to translate into strong free cash flow growth over the next 2 to 3 years, which I think can help the stock outperform.
All right. So, you got to take advantage of the opportunities when they come. You have to take advantage of the opportunities when they come. I keep harping on this. I'm going to say this over and over again. Invest. You have to take advantage of the opportunities when they come, right? So let's look at the charts real quick. Let me pull up the charts, as I usually do. Let's look at the S&P 500. That's a 3-month chart. Let's look at the 1-month chart. As you can see right now, I talked about these volatile times we had over the last couple of weeks. In October, we talked about this. Again, this is, the opportunities that come when you see these red dips down in October, a volatile month in the market, right? These are opportunities to get into different stocks as well as the S&P 500 as a whole on the ETF side. And if you just bought down in these red levels, down at the bottom on these red levels, right? 1, 2, 3, 4 times, 5 times it dipped in that month of October. It gave you week upon week upon week upon week ability to buy, and you've seen that rise up over the last few days, over the last week, and now we're starting to see a little bit of a movement down over the last couple of days, right? So again, these are all opportunities. People tell me, when should I buy stocks? I just always say, again, go to the chart, look at the timelines, look at the 1 month, look at the 3 months, look at the 6 month, and just look at how the movement of the stock works. And when you see some movement down, take a look at the opportunity and take advantage. All right. So real quick, let's look at a couple that I'm currently invested in. Let's look at Microsoft. This is a 1 month chart. As I said before, Microsoft, hit an all-time high 2 days ago at 553. It has now come down over the last couple of days and is sitting at this 518 level. This is definitely an opportunity to buy into Microsoft. If you look out 3 months, as you can see it when it comes down, these opportunities, when it does come down, opportunities come and you should take advantage of it. And as I'm looking at this chart, I need to possibly look into buying another option going out into next year. So shortly after this, I'm going to be looking into options for Microsoft. All right. So let's look at Google. Google stock has been on a rise. Let's look at the 1 month. Definitely been moving upwards. Opportunity down here to buy. Opportunity down here to buy. It has been moving upward. I am not investing into anything more into Alphabet, but again, you could look at this as a possibly opportunity also to get into it. So if you are a new investor and you're looking at a long-term outlook, not trading, but long-term outlook, it is something that you could consider getting into right now, right? Let's look at NVIDIA. Again, my number one company that I have in my portfolio, options out into 2026 and 27, as well as the most shares I have of any company is NVIDIA. And again, opportunities in the month of October, as we had some volatility, great opportunity to get into it around this 170 level. This is when I got into my options going out to 2026 and January of 27 when it was down at this 175, 176, 177 level. I got into those and we have risen up. And I have options that are sitting at 80, 90% gains in just a couple weeks based on opportunities and taking advantage and executing at a high level, right? All right, so let's jump into Meta. Woo, look at that. Look at that right there. We got to go farther out to start to take a look at the chart because of that dip that we just seen in Meta. Right. If you are investing in April, you can got in around 479. As you can see, it was moving upwards. It hit its peak right here in August, and it hit it's like a double top right here. Definitely lower highs. So this is a company right now that is in a decline. So when I say that we are possibly looking at a 600 level buy-in price, this is why I say that, and I want to see next week how the stock reacts to this current down turn from earnings. It is down a little bit over 2% on the day. On Friday, it was down about 10% yesterday. So usually when stocks go down, they take a few days to kind of figure themselves out. So it's important not to buy a falling knife, as they say, and you should, again, if you're a long-term investor and you're thinking about getting into a stock, this is an opportunity, even though it's down 12%, 13% on a day. I'm sorry, on a couple days now. Next week, it's going to be important to take a look at Meta and see if it's dropping more. Where is the bottom? Where is the potential bottom? And where could you invest in this stock? So let me just add an indicator real quick, because I want to see where the no, I ain't do it right now. Yeah, let's do it right now. I want to see where the 400-day moving average is and add that to the chart. Okay, so we sitting, let's go to a 1 year. All right. So look, this is why technicals is important. Right. So I just added a 400-day moving average. Right. Shout out to my guy Ian Dunlap for putting us on for the moving averages and EYL when it comes to, Invest Fest, right? Every August, right? If you are someone that want to learn more about, stocks trading, definitely take a look at Invest Fest. We already got tickets for next year for 2026, August next year. I'll be in Atlanta for Invest Fest. Shout out to you guys and everything that you have done for the community and for all of us when it comes to stocks, trading, and everything, right? So added a 400-day moving average. If you look down here in April, it came down and touched that 400-day moving average, and it went sky, and it went up after that, right? Right now, it has come down under its 200-day moving average, and it is moving in between that 200 and 400. So if we see this come down, again, look at that price. 605 is the price on that 400-day moving average at a 1-year out chart. I said 600 is a level that you want to pay attention to. Definitely, if we see Meta drop a little bit next week, we could possibly see it touch that 400. And I'm telling you, if it gets anything around that $600 level, 605, 610, it is absolutely a buy at those prices, right? So that is Meta. All right, so let's look at one more stock. We talked about the Google. We didn't do Apple, so let's go into Apple real quick. Last but not least, let's look at Apple. Apple has been on a rise, as you can see, moving upward. Definitely a great company. If you invested in it back in that April timeline, you could have got it down at 169. It is all the way up to 277 right now. It is on a continued rise up. I would not look to buy it right now. Wait for a pullback if you are interested in Apple specifically. Right. So those are the charts. As I always do, I want to take a look at a chart. I want you guys to see it. Again, if you are a new investor, putting some charts together, looking at, 2 to 3 moving averages really is where you can start. You don't need to add all of the other stuff that we do when it comes to technicals. I try to make things simple. I'm surrounded by people that really help me out when it comes to my investing, and we execute at a high level, right? So we talked about the Fed today. We talked about all of the earnings when it comes to the Magnificent Seven, some of the big tech companies in the world. We still are waiting for the number one company in the world of NVIDIA to report earnings. NVIDIA's earnings is November the 19th. That will be the inflection point for the continued run up to the end of the year. I'm going to repeat this again. That will be the inflection point for the continued run up for the end of the year. If NVIDIA earnings is good, which we all expect it to be, if you pay attention to demand when it comes to some of the other companies like Intel, AMD, right, Broadcom, etc., and you looked at some of the earnings reports for those companies, NVIDIA obviously is the number one player in that space. They provide the infrastructure for artificial intelligence. So we look at these companies, TSM and all of the other semiconductor players, NVIDIA is very likely going to blow it out of the water when it comes to their earnings report. So November the 19th is going to be a very, very important day for not just NVIDIA, but also the stock market as a whole, because NVIDIA is the highest weighted stock in the stock market, right? So I am in a crazy supporter of NVIDIA, obviously being the number one stock in my portfolio. When we see NVIDIA, blow out the report and the stock will go up like crazy, definitely will be a good day and a continued money maker moving forward, right? So as I always say to my new investors, man, invest. Choose the 3 to 5 great companies that you love. Invest in those companies, learn those companies, understand what makes those companies tick, why they're successful, why they will continue to be successful, and put your money towards those companies, gain shares, ownership, asset appreciation, dividend investments, reinvest those dividends and allow those things to compound over a long period of time. I'm so happy that I'm continuing to provide this information. I'm so happy to see the growth in the portfolio. This week has been a great week for the portfolio, and I'm also looking forward to the continued gains to come. More important than anything else, what I try to focus on is consistency and discipline. Consistency and discipline. Every time I get paid, we put money into the market. When opportunities come, we execute at a high level. We look at the stocks that we love. We want to invest more into those stocks, continuing to add shares, continuing to not make stupid mistakes and trying to trade, day trade, and all of that type of stuff. But ultimately looking at when opportunities come, am I prepared? Am I ready to hit the button and execute? And let me use artificial intelligence. Let me use my research, my understanding, my technicals, my fundamentals to make the best sound decision for the future of the growth of the portfolio. I love you guys. I appreciate y'all, man. Again, as I always say, hit the like button, subscribe to the channel, share this content with someone that needs to hear it. Leave me a comment and tell me who you're investing in, what you're investing in long term. I love you guys. I appreciate y'all. Again, we back next Friday as we continue to progress on this channel, as we continue to put out the information. Next week will be a little bit of an in-between week. We don't have tech earnings nearly as much, and obviously the Fed already cut rates. We have a government shutdown that's still continuing, so we have some uncertainty when it comes to that. A lot of SNAP benefits and different things is ending due to the government shutdown. So, I pray that all those out there that have issues, that have some struggles right now, reach out to your community, reach out to the people that's close to you to be able to help you out. All my government workers that's still furloughed, man, my heart to you guys when it comes to, your livelihood right now and, your day-to-day when it comes to your bills and everything like that, right? So we have different programs out there, Navy Federal, USAA, different military programs, federal programs that can help you out with no interest loans if you need it. Get through the time. It's crazy out here. The politicians ain't agreeing on much of anything. And I pray for you guys to continue to get through the time that you're in right now, right? So military members, same thing. Hopefully the paychecks will continue to come through. Continue to build up on each other and continue to be there for each other, man. I love you guys. Appreciate y'all. If y'all need me for any reason, hit me up on my email. It is on the channel. And hit me up on Facebook, hit me up on Instagram, and let's continue to progress on our financial journey as well as our financial future, man. I love you guys. I appreciate y'all. I'm out. Antoine Smalls, Financial Blueprint. Stock Market Live show on a weekly basis is out, man. I love you guys. Have a good weekend. Peace.